In real terms, gold's gone nowhere. In fact, it's probably down. 60% equities, 40% bonds. That was the safest investment style of all, and the entire pensions industry worldwide uses it as its benchmark. We've just had the largest drawdown in the history of that strategy. This is unprecedented. People are record negative sentiment. To go lower, suck more people into short, and then rip higher. The dollar is in this doom loop where it's a game of musical chairs.
Raoul Pal is a macro guru. He is most famously known for predicting the 2008-2009 mortgage crisis, as well as being co-head of hedge fund sales at Goldman Sachs. Retiring from Wall Street at 36, he leads his financial media company, Real Vision, where he curates information from the world's best investors. In layman's terms, he knows what he's talking about. In this Q&A, Pal discusses the current state of hedge funds, the secret solution to inflation, and the future of the dollar system. Stay tuned if you want to know which asset classes are growing and which will shrink in the coming years. Armed with this knowledge, you will know where it is easiest to get your slice of the pie.
What role does gold play in the investment landscape? You see, there was a narrative from the 1970s that has been held on to, particularly by boomer types, which is that you see one day this financial prolificacy will create a bull market in gold again. When you look at gold mining stocks since the 80s, they've actually not gone anywhere. When you look at gold, it has risen, but it's not risen with inflation. In fact, in real terms, gold's gone nowhere. In fact, it's probably down. The reality is gold does a certain thing and it does it really well. Gold works really well when you debase a currency. Remember in the old days, they used to debase gold by clipping the corners off the edge of coins. They don't do that now. What they do is devalue your fiat currency. When you look at a chart, and I've got a global macro investor chart of gold over the last 20 years versus a basket of 27 of the largest currencies in the world, excluding the dollar, gold just kind of ratchets higher. And it ratchets higher every time there's a devaluation of other currency. It also works okay against the central bank balance sheet. It's not racy, but it kind of does its job. So gold right now, when you've got positive real rates, and they're going up a lot because the bond market's decoupled from everything else, what you've got is a bad environment for gold. The moment the real rates go negative again, that's destroying your future wealth. Gold does pretty well. Now, I don't think gold is the best investment to capture this tail risk. I actually think crypto is much better at doing it. I actually think technology stocks are probably better at doing it. But gold is less volatile, so risk adjusted, it's just fine. Why? The dollar is in this doom loop where it's a game of musical chairs. The musical chairs here are the US is 25% of world GDP. 87% of world trade is in US dollars. Most international borrowings are in dollars. The Eurodollar market is the epicenter of that. The issue is when the Federal Reserve start taking money out of, or liquidity out of the system, it knocks through to this murky world of Eurodollars and foreign dollar borrowings. And those weaker borrowers start scrambling for the dollars. And it's a game of musical chairs where somebody gets rug pulled and somebody falls to the floor because there's not enough chairs to go around. Not enough dollars. That was Sri Lanka. That started this off, and I tipped you guys all off about it back in March, I think it was. Then after that, we've seen numerous countries go into default or renegotiate with the IMF and the World Bank and others. That's the shortage of dollars. The shortage of dollars is what puts the European banking system under pressure. The shortage of dollars kind of knocks through for the global market. Now, there's another issue going on right now is the US, its trade deficit. If you think of a trade deficit, it's the US buying goods abroad. That's spending dollars elsewhere, so the rest of the world gets those dollars and they get to recycle them into treasury bonds or do other stuff with them, have borrowings against them. When the US runs a smaller deficit, there's less dollars in the global system. So that makes another problem. So you've got liquidity being sucked out and you've got the trade deficit, meaning less dollars are going in the system. Yet in a slowing economy, everyone needs to pay the interest on their debts. So demand rises. That's the mess we're in. Foreign central banks end up having to sell their treasuries to either support their own currency or because they kind of need other things to be able to do with the dollars that they hold. That becomes an issue, or they want to receive the dollars to pay off the interest on their debts. That becomes an issue because it's driving higher interest rates. Right now, the interest rate market has no buyers. There's no buyers of bonds. I've never seen this before. You see, the issue is traditionally the buyers for foreign central banks, they're out of the market. The Federal Reserve with quantitative easing, they're out of the market. The banks, the biggest buyer of all. Regulatory purposes meant that they can't do it. So cash is piling up in the reserve repo market. So there's trillions sitting in there with nowhere to go, not being put into the system. And the pension system. And the pension system has just taken the biggest loss ever in the 60-40 portfolio. That's the portfolio of equities, and bonds, 60% equities, 40% bonds. That was the safest investment style of all, and the entire pensions industry worldwide uses it as its benchmark. We've just had the largest drawdown in the history of that strategy. This is unprecedented. I know everybody looks at the equity market and says, well, the equity market's only down 30% if it's the NASDAQ or 20% if it's the S&P. They're missing the fact that pension portfolios have been obliterated. So if you think what just happened in the UK, there was some leverage to cover their liabilities, and with this drawdown, they blew up the pension system, and the Bank of England had to come and step in. So that's the dollar problem. The dollar problem is great for the US right now because it means that anything you buy from abroad, particularly the US buys an enormous amounts of finished goods from China, Germany, or Europe, Japan, South Korea, Taiwan. Those are the big industrial nations that export goods. All of their currencies are down between 15 and 30% against the US dollar. So the US dollar imports deflation, not inflation, from those countries. Those countries are importing inflation. So Japan quashed their bond yields by yield curve control, and that has the knock-on effect of them printing more currency, which devalues the yen. So we go back to the previous conversation is, guess what? The yen in gold terms, or gold in yen, looks great because somebody was devaluing their currency, and gold helps you nicely sidestep it.
Hit the like button and subscribe to get immediate notification of tomorrow's video, where Federal Reserve insider Joseph Wang exposes that the Fed will keep interest rates high until they see this specific signal. Don't lose money front-running a Fed pivot without watching this essential investing highlight. Pal goes on to discuss, in his words, the pain train, his predictions of the economy 5 years from now, and where technology and a decreasing population leads. Do you think an increasingly robotic workforce is a good thing, or is it a bad thing?
The pain trade, I think, is to sucker everybody in thinking there's a great glory collapse to come. The I told you so moment in earnings are going to get revised lower. Well, all I do know is people are record negative sentiment. They're more negative than I've ever seen, ever in any history. I wrote a big article in Global Macro Investor, my institutional research service, about this. They're super negatives. People are super hedged. Put volumes have been incredibly high. So I think the path of pain is to go lower, suck more people into short, and then rip higher. And it would rip higher because bond yields start to fall as they start finally recoupling for the business cycle. Bond yields have massively decoupled from the ISM survey. That's a relationship that's gone back 50, 60 years, including the last inflation episode. It's decoupled from inflation break-evens. It's decoupled from economic growth by any measure. The bond market, to me, is broken. It is now a function of illiquidity because nobody's involved in the market and there's only sellers. And I think it's going to cause some tremendous problems. And that eventually is going to create the answer. And the answer to everything is always more cowbell. The UK showed it. More cowbell, print more money, get us out of this problem. When people say they'll keep hiking until it breaks, well, when it breaks, more cowbell. The whole system is now set up for one cry, which is more cowbell, turn the taps back on. It's a sad state of affairs, but that's how it is. But you can trade that to your advantage. Trading it to your advantage is understanding when that shift comes and what it does for risk assets. It's very attractive. Clearly, we're in inflation right now. You have to be a blind monkey not to realize that. I actually didn't think it would go this high, but I also didn't actually have in my bingo card Russia invading Ukraine. But we get these things wrong. That's the part of market. My view is that this inflation turns to deflation. I know there's a massive analysis of structural inflation driven by supply issues in the oil markets. We could see that today, this fight that goes on between supply and demand. I know a lot of people think that much of this is stickier. I know a lot of people also just emotionally want to punish the Fed for quantitative easing because they want to prove that it has inflation. Those tend to be the gold types. We told you so, angry men shaking fist at the sky on the internet. My view is that when you have a year-on-year rate of change of interest rates like this, when you have the mathematical effects of these numbers for next year, bloody hard to have positive inflation. And my guess is it goes negative. And my guess is a recession causes more demand destruction. Also, when you allow the dollar to go up that much, you increase the probability that China and others will start to push to move away from this dollar system. Even the Europeans want to get away from a dollar system. So the US can have a strong currency. If it goes a too strong currency, my point has always been they sow their seeds of their own demise of the dollar as the reserve standard, and we will bifurcate and multiply different currency systems for different use cases. 5 years' time, technology continues its relentless rise. Cryptocurrency continues its relentless rise. The baby boomers are retiring and starting to die. Growth has ratcheted down. GDP growth is a very simple equation. GDP is population growth plus productivity growth. Population growth is shrinking. Immigration is politically unacceptable in an age of not enough jobs because of robots and AI. Productivity is the robots and AI. That's going to be the new demographics, replacing the lost workers. It won't replace them at scale, but eventually we get to the tipping point where it's much cheaper to employ a robot. Look at Amazon. They've employed something like 750,000 new people over the last 4 years, and they've employed 500,000 robots in the last 5 years. The robots work 3 times as many hours because they don't take a break, they don't take holidays, and they're more productive. That is relentless, and that is not going to stop.
I highly recommend this eye popper, where the famous and always cranky-sounding Swiss investor Mark Faber reveals where he believes the world economy is destined to go.